may I explain it, Brad, so you'll know as you consider what happened here. In order for this four-party transaction that I described, the Starker, deferred, like-kind, non-simultaneous exchange to work, the accommodating party must be independent. And the regulations, and I have brought these for you to take with you, the regulations are very clear that the accommodating party must be independent. For example, it's very clear. It says if you have an ongoing relationship with an accountant, with an attorney, with an investment bank, with some other entity, other than serving as an accommodating party, then they're not independent of you. So you could not use your family lawyer, who is no relative at all, as the accommodating party because you employ that family lawyer to do your will or to handle other things within the last 2 years. So there's a 2-year look back rule to see if that accommodating party is the trade name for that entity that facilitates these things, is independent. If it's not independent of you, it's deemed to be your agent. If it's your agent, then for purposes of the law, when you give the real estate to your agent, you have not parted with it. Now here's the problem. If you have not parted with it, and you then, through your agent, sell it to the cash buyer, receive cash, later take that cash and buy the replacement property, you have a taxable transaction because you didn't use an accommodating party. It has to be set up correctly with an independent entity as an accommodating party. So in this transaction, even though it's very clear to me that Mr. Horn in good faith believed he had an independent entity, he did not. He had an entity that he controlled. And because he controlled it, it's not independent. And so at the time of sale by this controlled entity for cash, there was a taxable transaction. To put that into an example that follows on the transcript, if it was a $3 million building, that's what I think he gave an example. He said 6 million, but let's just say I sold one for 3, put in $1 million, took the 3 million of resale proceeds and bought a new one for 4. That works if you have an independent entity as the accommodating party, if you meet the other requirements. It's all must close within 180 days and other requirements under law. But if you have an agent, then it does not work, and at the moment of sale to the cash buyer, you have a taxable transaction. $3 million of cash came in. With depreciation and such, you may have only a $1 million basis left. You've got $2 million of taxable gain. Presumably that wasn't reported on Mr. Horn's tax return because he believed it was not reportable.